Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of Poonawalla Fincorp Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. To ask a question, participants may press star and 1. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hiren Shah, Head Investor Relations, Poonawalla Fincorp Limited. Thank you and over to you, sir.
Thank you, Rutuja. Good evening, everyone, and thanks for joining this conference call. It's our pleasure to welcome you all to discuss Poonawalla Fincorp's business and financial performance for the quarter ending September 2022. We will take this opportunity to update you on the recent developments in the industry as well as Poonawalla Fincorp during the quarter. To discuss all this in detail, I've got with me our Managing Director, Mr. Abhay Buttada, Managing Director of Poonawalla Housing Finance, Mr. Manish Jaiswal, and other senior management officials, and myself, Hiren Shah, Head of Investor Relations. Now, I would like to request our Managing Director, Mr. Abhay Buttada, to brief you all about our company's operational and financial performance, along with developments for the quarter ending September 2022. Over to you, sir.
Thank you, Hiren. Hello, everyone. I welcome you all to the Poonawalla Fincorp Q2 FY23 earnings conference call. Trust you are all doing good. On behalf of entire Poonawalla Fincorp team, I wish you all a very happy Deepavali. Let me take you through the key highlights for the quarter. Q2 has been an excellent quarter with differentiated strategy and execution excellence, leading to all-round performance across business growth, improved credit quality, and profitability. It was a quarter marked by highest ever organic disbursement, customer acquisition, lowest GNPA and NNPA, and highest ever PAT and ROA. Also, our long-term rating was upgraded to AAA stable by CARE Rating Agency. This sets the momentum for an even exciting second half and beyond. All this is a testimony of leadership team's relentless effort and focus toward achieving the management vision and creating value for all our stakeholders. During the quarter, our PAT increased to 163 crores, up 71% year-on-year, 16% quarter-on-quarter. Our ROA reached highest ever level of 3.6 at a consolidated level, an improvement of 102 bps year-on-year, 24 bps quarter-on-quarter. Our AUM stood at 18,560 crores, up by 22% year-on-year and 5% quarter-on-quarter. The focused AUM growth was even higher at 56% year-on-year, 11% quarter-on-quarter, as fresh disbursement grew by 44% year-on-year and 8% quarter-on-quarter to rupees 3,721 crores. NIM was at 9.8% in Q2, increase of 77 bps year-on-year and 35 bps quarter-on-quarter. NII stood at 446 crore, an increase of 33% year-on-year and 12% quarter-on-quarter, while the average cost of borrowing was contained at 7.12 for the quarter, despite a 190 bps cumulative repo rate hike since May 2022. In terms of asset quality, we aligned stage 3 classification with the revised NPA definition as per the RBI. The aligned GNPA reduced to 1.52, down to 59 bps year-on-year and 67 bps quarter-on-quarter, while net NPA reduced to 0.83, down 118 bps year-on-year and 13 bps quarter-on-quarter. I am happy to share that this is the lowest GNPA and NPA levels in last 38 quarters for us and amongst the lowest in the NBFC space. This is driven by our chosen customer segment, the high credit bureau score portfolio, superior collection infrastructure, close monitoring of early warning signals, coupled with proactive credit policy changes. At Poonawalla Fincorp standalone level, our PAT increased to 130 crore, up by 76% year-on-year and 5% quarter-on-quarter. Also, our AUM grew by 17% year-on-year and 4% quarter-on-quarter to 13,161 crores. ROA standalone was at 4%. This is the highest ever ROA for the standalone for the quarter ending September 2022, which is an increase of 131 bps year-on-year. The focus AUM, which is 88% of our total AUM, grew at 68.5% year-on-year, 12.5% quarter-on-quarter. The entire disbursement during the quarter was through organic route, which grew by 42% year-on-year to rupees 3,110 crore, for Poonawalla Fincorp at a standalone level. The NIM stood at 10.4% with an increase of 55 bits year-on-year, 3 bits quarter-on-quarter. GNPA was at 1.77 with a reduction of 302 bits year-on-year, 91 bits quarter-on-quarter, while net NPA stood at 0.94% with reduction of 132 bits year-on-year and 17 bits quarter-on-quarter. The affordable housing finance subsidiary PAT grew by 75% year-on-year and 8.3% quarter-on-quarter to rupees 33 crore, while the AUM stood at 5612 crore, which is up by 31% year-on-year and 6% quarter-on-quarter. Poonawalla Housing Finance Limited disbursement stood at 611 crore, which is up by 57% year-on-year and 14% quarter-on-quarter. Now let me elaborate on our execution strategy during the quarter. Starting with business growth, we focus on developing diversified disbursement engines that has aided growth of organic disbursement. Organic disbursement rose 180% year-on-year, 32% quarter-on-quarter. Over the course of last 1 year, our organic disbursements have increased 2.8 times. We ended September at a monthly organic disbursement run rate of 1300 crore against given guidance of 1000 crore. With a focus on the direct digital program, the disbursement growth has been accompanied by lower customer acquisition cost compared to traditional distribution model and has also accelerated the customer acquisition. The DDP mix has risen to 47% in Q2 FY23 from 34% in Q1 FY23 and 17.5% in Q4 FY22. Led by strong data analytics, cross-sell, upsell has also seen good traction contributing to overall growth and profitability early on. Our focus from day one has been on instilling the culture of building digital-first technology-led organization. I'm happy to share that we have now fully operationalized in-house technology center dedicated to our digital tech, analytics, and other agenda. On liability side, despite the rising interest rate environment, our cost of borrowing increase was largely contained. As highlighted earlier, CARE upgraded our long-term rating to AAA stable, and this would further help us contain the increase in cost of borrowing despite rise of 190 bps in benchmark rate in this fiscal year so far and further rise. We are still carrying almost 1300 crore of our legacy borrowing at 9.5%. We recently started our capital market borrowing. We raised around 1200 crore in the last quarter via CP and NCD route. Otherwise, we are again amongst the lowest in terms of cost of funds if you do apple-to-apple comparison. Having had a fantastic first half, let me take you through to what we can expect over the rest of financial year. While we are in a rising interest rate and liquidity deficit environment, the market segment in which we operate, that is consumer largely and MSME, continue to grow. The ongoing technology disruption in lending favors digital fast-tech-led players like us. With the full-scale operationalization of our technology center, we will accelerate digital offering in a rapidly growing areas of embedded and contextual lending. In the upcoming quarter, you would see us leverage of our technology, digital and customer service capability to further enhance our superior customer experience and thereby build a competitive moat. With a monthly organic disbursement run rate of 1300 crore in September 2022, we have a strong business momentum for the upcoming H2 FY23. We are confident that we will continue to have among the best asset quality in the NBFC space, and we will maintain a net NPA less than 1 with our management vision 2025. Our current OPEX to AUM stands at 5.9% since we continue to invest in capability building in technology, invest in people. Also, we have given ESOP to more than 400 people, which is almost manager and above more than 35%, and our total employee population of 3,200 enrolled people almost cover 15%, which is the highest in the industry. With this reduction of ESOP charge going forward, we expect a sequential decline in this ratio from next financial year onwards, because there is a 35 to 40 crore ESOP charge in the last 2 quarters, which will be there for the current year. But despite of that, there is an increase in the pre-operating profit as well as one-time cost and huge investment in the team as well as building digital and other capabilities. Now we are expecting drastic reduction in terms of OPEX from the next year onwards. With the leadership team in place, best-in-class digital infra and other technological capability, highest credit rating, expanding our product suite, and the best-in-class asset quality, we are confident of a strong growth trajectory in FY23 and beyond. And Now, considering this exceptional performance, which is in line with our management vision 2025, I assure you that whatever guidance we have given till date, we have achieved, and we are going to achieve as per our stated vision. Thank you, everyone, and now we can start the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sameer Bhise from JM Financial Institutional Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity and congratulations to Abhay and team for a superb quarter. Wanted to get a few data points before I ask other questions. Can you elaborate on the AUM mix on the focused business right now across products?
Yeah, thank you so much, Sameer. So right now, we have more than 2,300 crore in terms of pre-owned car. Auto lease, we are approximate 286 crore. And unsecured personal loan, business loan, loan to professional, we have 5,135 crore. Then we have other products which we acquired last year, the DA book, which is outstanding at 2,609 crore. And the existing legacy book is around, including few other products, 1,540 crore. And now we have housing 4,927 crore and PHFL acquired DA 686 crore, which is approximate 18,560 crore. And if you want to focus on a monthly number, then we have crossed 180 crore on a monthly disbursement basis on a POC, pre-owned car. Then we are doing around 30 crore per month on auto lease. We are doing almost 300 crore on a business loan side. We are doing almost 200 crore, including digital ecosystem, more than 250 crore in per month on a personal loan side. We are doing more than 130 crore on a loan against property side. We are operating at 30 locations in loan against property. Other all products we are operating at 110, 120 branches. So I think this is one of the best number in the NBFC industry because as of now, considering our monthly run rate of 1,300 crore, we are just operating at 110 locations.
Okay. This is helpful. Some details on the kind of customers acquired, maybe in terms of number of customers or profile, will be helpful.
Yeah. So more than 70% more than 80% of our customers, they are 730 plus CIBIL. And this quarter we have acquired closer to 4.65 lakh customers.
Across all product lines?
Yeah, across all product lines. This is the highest ever customer acquisition. And now we are expecting this number will increase drastically over the period of next few quarters.
Okay, and where does the return of book stand at this point in time?
Samir, what do you mean return of books?
Previously return of book. You just wanted to get a sense.
So legacy, Samir, legacy write-off book, we have closer to 1,100 crore. So we have a write-off policy since acquisition of 90 and 180. Yes. So we have done a lot of write-off against that as per the policy. So we are at 1,100 crore and considering the past trend of 40 to 45%, and because of the early write-off, even you can consider 45%, we are going to recover over a period of next 12 to 18 months.
Okay. I think for now this is helpful. I'll probably get back in the queue for the questions if at all. Thank you so much and all the best.
Thank you, Samir.
Thank you. Participants are requested to use press star and 1 to ask a question. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Good evening and thank you for giving me the opportunity. So the question was with respect to the discontinued book. You said it is close to 1,100 crore. I suppose last quarter it was 2,000 crore, and I think the coverage there last quarter was close to 9%. So is there a write-off there, or entirely it's broadly due to repayment? So if you could just give some color on that.
Yeah. Hi. So, yes, there is a write-off. The total write-off is about 364 crore, okay, which we have done, including policy write-off. It would be about 460 crore. So the discontinued book, yes, has been written off. So as we speak, the discontinued book has come down significantly to 1540 crore, okay, which Abhay talked about. But if we take only the on book, the discontinued book is down to about 1270 crores.
So if you remember last quarter, we have informed that we have created a management overlay of that one-time insurance stake sale profit, which we have utilized for the legacy book, which was created only for the legacy book. So right now we are not expecting any, whatever on-book legacy book is there, except from the policy write-off, we are not expecting any additional write-off. However, we want to come out of this legacy book so that there will be a proper comparison, and by end of March, legacy book will be below 500 crore, whatever will be there on book.
Okay. So the second question was with respect to the newer segments that we have sort of entered in the last 1 year. So while you did give some color that, during the quarter you have acquired 4.65 lakh customers with more than 730 CIBIL, if you could give some details on the bounce rates for these segments and 1+ DPD number. So some of the asset quality indicators that you would be tracking, if you could give some color on that, will be very helpful.
Sure. So on that side, I think we are maintaining our 60 plus is less than 0.4%. And since we do write-off, we are the very few amongst the NBFC who do write-off at 90 plus unsecured and secured at 180 plus. So there are no write-off in the newly acquired book, and our 18 months of experience in Poonawalla Fincorp and the existing track record of Poonawalla Finance of the group, wherever 2-3 years personal loan, professional loan, business loan, we all, whatever experimentation was done, and there also we used to write off at 90 plus, we carried the same overall learning, and right now the 60 plus is less than 0.5%.
And sir, what would be the bounce rate in some of the segments like MSME and personal loan?
So here in personal loan, 30 plus personal and professional loan, 30 plus is less than 0.10. Because the segment which we are targeting, because of the low cost of fund and the digital acquisition, we are able to give a very fine rate as compared with any other larger NBFC. And I want to give you some additional data point here. Whatever initial assessment done by internal team member, I think we are getting first choice of rejection in terms of personal loan and the professional loan. The entire process is digital. There is no single signature required. 100% digital. Of course, we have gone all 100% digital across all our product, including pre-owned car. But in personal loan, professional loan, there is no DSA. So we are saving straightaway 3 to 3.5% the DSA acquisition cost. We have stopped DSA 4-5 months back, and this is completely direct and digital acquisition.
Okay. So we pay a DSA fee of how much do we pay to the DSS for these loans?
So personal loan, professional loan, there is no DSA. In case of business loan, we have some DSA, and loan against property and pre-owned car depends on the product to product and channel to channel.
So what would be the payouts?
So payout, again, it varies, but that is as per the industry standard.
Oh, so if you could give some range, maybe say 25 to 75, or if you could give some range there.
So for example, for business loan, we give payout anything between 2.5 to 3.5 range, depend on the volume and slab. But there the IRR is 19%. We get upfront processing fees of 2% and additional other cross-sale income. In case of pre-owned car, again we give around 2 to 2.5%, depending on the slab. And in case of loan against property, we give between 1 to 1.25%, depending on the slab.
Okay, got it. And sir, in the housing business, like I read in the presentation that we have initiated the IPO, I suppose. So what is the timeline and what is the thought process?
So as of now, we will not be able to give much detail. We have appointed the investment banker. The process is going on. Maybe in couple of months, in 2 to 3 months, we'll be able to give you more detail on that. As of now, the process is going on as per the plan.
Got it, sir. Got it. Thank you so much, sir. If I have more questions, I'll come in the queue, sir. Thank you and happy Diwali to the entire team. Thank you.
Thank you. Thank you so much.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Harshvardhan Agrawal from IDFC Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. So just wanted to understand the line item that we have this time, net gains of recognition of financial instruments. What does this pertains to?
So basically, as per our stated objective from the last quarter onwards, we have decided to come out of that existing Magma legacy book. And apart from the write-off, whatever was the zero DPD, and because of that different kind of customer segment in nature, we started selling that book as well.
Okay. So this is we have sold down some book, and this is we have whatever the fee that we have got. We
got from the legacy sold out book. Yeah.
So is this 33 crore will recur every quarter, or this is a one-time income?
No. This is a one-time income, and again, whatever is the additional recovery we will get maybe next 1 to 2 quarters, because as I have discussed just now, we want to keep legacy book 500 crore by end of March, and maybe by June 2023 we will be out of legacy book. So one is a policy write-off or additional write-off, and second is we are selling because we are not able to do cross-sell on the existing Magma, Agri, CVC, tractor kind of customer. So we decided to sell that book, and now the balance legacy book is less than 500 crore, whatever is on book.
Right, got that. So sir, since because this is the one-off income, if I were to take off this income from our revenue line item and then see the quarterly growth between the AUM and the quarterly growth between our NII, seems like our NII is trailing the AUM growth. Is it? So how do I read it? That is it the incremental book coming at a lower yield, or the cost of funding is increasing at a rapid pace? How should one read into that?
No, so initially acquired book which was at a lower rate, and now we have increased the rate from last 2 months. Initially we started to focus on a lower rate, but now we have enough scope. Still we are offering the lowest rate as compared with any other larger NBFC. We have still scope to increase 100 and 150 basis points. So we have increased 100 basis rate from last 2 months after the RBI rate hike, and now you will see further increase in the yield going further.
Sure. And so one last thing is about the credit cost line item. Due to the excess provision that we have done in the past, we are able to do some write backs over the last previous quarters. So how should one really build in the credit cost if we were to look at, say, FY24 or even FY25, just in terms of modeling the credit cost line item?
So basically, because of the still write-off book available, you will not see actual P&L charge on the same. But however, credit cost, anything you can consider in the range of 0.5 to 0.7%.
And how long do we have this flexibility of write backs on credit cost?
So basically, whatever, though we have done early write-offs from the legacy book, but we need to recover that, right? And we are going to recover almost 45 to 50% of that. So that will take 12 to 18 months. So that is additional cushion available against the balance legacy book available. So that's why we are not expecting any losses from the balance legacy book. In fact, we may expect a write back of 150 to 200 crore over a period of next 12 to 18 months.
Right. So just to understand that, maybe for the next 4 quarters, we may still continue with this negative credit cost line item. So fair assumption to make?
Yeah, at least for next 2 to 3 quarters.
Sure. Thanks a lot, sir. I'll get back in the queue for more questions.
Thank you. The next question is from the line of Kaitav Shah from Anand Rathi. Please go ahead.
Good. Hello, am I audible?
Yeah, you are audible.
Yeah. Good evening, sir. Congratulations for good set of numbers. My question was more related to your customer acquisition. If you can give us more detailed understanding about how much is new to bank, how much is customer profile in terms of own source, organic sourcing, and how much is BSA acquired. If you can give, break it up along those lines.
So basically, if you see out of our acquired total customer base, So our direct digital program is running well. We have crossed 47% of the total disbursement, and more than 90% is a directly acquired customer under direct digital program with our digital ecosystem partners, and only 5% of the total customer count is via DSA route. And here more than 95% are credit tested customer, GST tested customer, and hardly there are less than 5% new to credit customer, that too under partner ecosystem, wherein we have done 2 or 3 co-lending, wherein we are getting 10% FLDG. So there is no actual loss to us.
Fair enough. I think that was my broad question. Thank you.
Thank you so much.
Thank you. The next question is from the line of Aniket Jain from ABFL. Before we take the participants, reminder to everyone, to ask a question, you may press star and 1. Mr. Jain, you may please proceed ahead with the question. Mr. Aniket Jain, you may please proceed ahead with the question. Mr. Aniket Jain, may we request you to please unmute yourself if muted from a handset. As there is no response, we'll move to the next question, which is from the line of Hina Vora from Systematics. Please go ahead.
Hi, good evening. Can I just know the EOM mix and mix of your numbers?
Can you please speak loudly?
Can I know the EOM mix and mix the numbers then?
EOM mix. You're talking about secured, unsecured EOM mix?
No, the focus business EOM mix.
Product-wise. So product-wise, we have already stated, but I will just give you an idea of this. Housing, we have 5612, and Poonawalla Fincorp at a standalone, we have more than 13,000 crore. Out of that, professional loan, personal loan, business loan, and other digital unsecured products, we have 5135 crore. Loan against property 1241 crore. Then existing acquired DA 2609 crore. Our existing legacy book 1540 crore. Auto is around 286 crore, and pre-owned car, which is 2317 crore. And on a monthly basis, I have already. Can you hear me?
Yeah, sure. Oh, thank you.
On a monthly basis, we are doing 180-185 crore on a pre-owned car. Auto is around 30 crore. Business loan 300 crore. Personal loan around 250 crore. Loan against property around 130 crore. Housing side, we are doing around closer to approximately 200 crore per month.
Okay, thank you. Yes, that's it. That was my question. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. So firstly, sorry, with respect to this 33 crores, and overall when we look at it in terms of the provisioning right back of almost 41 odd crores. So cumulatively, maybe from the return of book, would it be fair to assume that maybe on a net basis the recoveries are more than 70 odd crores? How didn't get the difference in terms of the provisioning right back and what's there in the right in the fair value, yeah.
Yeah. So Kunal, recovery from the write-off book for the quarter was 75 crore.
Yeah, it was 75 crores. Huh? Okay, perfect. Got that. And when we look at it overall in terms of, say, stage 1 and stage 2 PCR, okay, which is also coming off on a quarter-on-quarter basis, particularly on the PFL side. So this is largely because maybe there was some write-off book out there also, which is, or maybe something which was written off from that pool as well, which is leading to this kind of a decline in PCR?
Yeah. So basically, we do write-off of unsecured at 90 plus, and again secured at 180 for a legacy book as well as for the new book. And considering the latest last 18 months performance, there are no early delinquencies also in the new book. However, yes, PCR will, because of the write-off of the legacy book, it will get reduced going further because we require stage 3 provisioning only and only for the secured book.
Got it. And on the restructured side, so out of 467, 211 is zero bucket, and the balance also we are quite comfortable because I think it's slowly coming up, but entire thing is not yet out. Okay, maybe out of the moratorium. So maybe any expectations on maybe the slippage from that pool, or that's performing well?
So that book is performing well. As we discussed, out of the 467 crore, now 211 crore, which is into zero book, almost 45% of the restructured book. And against the pending restructured book, again we are getting EMI, and whatever we wanted to write off, we have done the write-off in last 2-3 quarters from that pool as well, because this is 100% the legacy book.
Okay, so there also the write-off is done, so there shouldn't be any further provisioning coming in from the restructured side.
Yeah, because if you see, Kunal, this GS3 number also, we have aligned to this new RBI norm. That's why our GS3 and NNP numbers are reduced by drastically. But at the same time, if you ask GS3 and NS3, that is much lesser as compared with the GNP and NNP.
Sure. And given now maybe the experience over past few quarters, the kind of run rate which you have highlighted on a monthly basis with respect to say BL, PL, as well as maybe on the pre-owned side, do we see that maybe either of these segments would do relatively better because we have still been say on an investment phase and that is yet to scale up? No doubt there will be overall business growth, but in terms of the proportion wherein they are, do we see a couple of them significantly outperforming the other?
I think at the overall console level, we are maintaining 70-30 secured and unsecured mix. However, if you see whatever product we launch, pre-owned car, business loan, personal loan, professional loan, and loan against property, as I told you, we are operating at only 30 locations in loan against property, and other all product at 100 locations. If you do peer-to-peer comparison, then I think we are in top 2 or top 3 in most of the product. And this is just a start. Now we have completed the whole consolidation phase. Now since last 2 quarters we are in growth phase. So you will see a good monthly, the closing run rate will be much better as compared with the first half. Second half will be much better. And the actual growth is also more because of this legacy book write-off. On paper, quarter on quarter, the overall AUM growth looks on a lesser side. But because of the legacy book write-off and discontinued book run down so fast, the actual growth is much more in all the newly launched products. And the segment which we are targeting, we are not expecting any early delinquency or credit cost, whatever we have given the guidance of 0.7 to 0.9, I think we will be able to maintain that.
Sure.
And Kunal, as we discussed in the last quarter also, this time also we want to give this, that OPEX will get reduced drastically in the next year. See, we have covered more than 400, almost 430, 450 people in ESOP and the RSO. So that is a notional charge on the P&L. So last quarter it was almost approximate 40 crore. This quarter also is 44 crore. If you see our pre-pop, it would have been higher by almost 40-45 crore. So actual profitability is much higher. But despite of that, yes, there is an increase in the pre-pop and across all other parameters.
Yeah, so this 160 to 180 crores would be there for this fiscal, and then maybe next year onward this should run down.
It will get reduced by maybe around 55-60, and third year it will be around 20-30 crore, because in the first year itself, to retain the top talent, we have covered the larger population till the junior level, middle level, and entire senior leadership we have covered, Kunal.
Okay, so 160, 180 crores in this fiscal and coming down to 55, 60 next year, and then 20 to 30 in a year after that in terms of the cost.
Yes.
Okay, great. Yeah.
One-time cost as well, since we are largely investment in technology and team we are building. So there are a lot of one-time cost in the last 2 quarters or maybe next 1 quarter, 1 to 2 quarters, but that also will get reduced in the next financial year.
Sure, got it. Yeah. Thanks. All the best, and wish you a very happy Diwali to you and your entire team. Yeah. Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Dhaval Gala from Aditya Birla Sun Life Asset Management. Please go ahead.
Good evening, the top management team of Poonawalla. Congratulations on good set of numbers. Few questions. First being, Abhay, if you could articulate around AUM growth, and basically we do understand right now we were in a restructuring or a reorganizing phase because you were running down some books which you did not want to grow, and you were growing personal loans and other segments. If you could talk about is how do one look at sustainable growth? Also, what is basically if you could provide some more color on customer profile also, and how sustainable the growth would be in the medium term.
Sure. Thank you so much. So, Dhaval, in terms of growth, if you see September 21, the focus AUM was 10,900 crore. Now, within 1 year, we have reached 17,000 crore in terms of our focus growth. And discontinued book as 1545, the total comes to 18560. So I think almost more than 80% growth in terms of the focus AUM growth in 1 year. But as per our management vision, 3x AUM of March 21 to March 25, so we'll be able to grow considering the current monthly run rate, considering the capability we have, considering the market opportunity available, we will be able to grow anything between 30 to 35% over a period of next 3 years to achieve our 3x growth by March 2025. And on the customer profile side, I think mostly we are targeting a bureau-tested customer. Data, technology, and the overall tech center is more than 200 plus team now. GST tested customer, TDS. So a lot of informal income segment wherein people are paying statutory dues on time. PDF banking is available. Almost everyone is focusing on the same, but at the same time, in terms of TAT, in terms of customer service, in terms of product proposition, I think we are far better as compared with other large competitors. Basically, what feedback we got from a lot of customers, that we are the only NBFC at a larger scale who is offering zero prepayment charges across all our products if we pay from the own charges. At the same time, of course, we will charge some penalty if there is a balance transfer. But in terms of product proposition, no hidden charges, rate, processing fees, TAT, overall customer product proposition, and the digital user experience, 100% digital. So customers are giving clearly first choice of rejection in most of the products. And of course, the Poonawalla brand and brand equity is there as a trust factor.
Sure, sir. Just a couple of more questions. One on the customer franchise, if one has to understand. I do understand how you've been, it means your articulation around new segments of growth. But what is cost of acquisition in the real sense? And when you mentioned about operating leverage, a couple of questions back, somebody asked, how do one consider what type of customer base you are building? And do you have any analysis that how much of cross-sell you'll be able to do over a period of time, long term, and therefore operating leverage can come down?
Yeah, very good question.
Operating expense can come down and you can have higher operating leverage.
Yeah, so out of our total monthly disbursement, Dhaval, total 47% is our DDP, which is direct digital ecosystem, wherein our total customer acquisition cost is less than 1%. And in case of the other DSA cost and a few other costs, the customer acquisition goes to around 1.5 to 2% on an average basis. And in terms of cross-sell, I think whatever data analytics we have done, we will be able to do a lot of cross-sell. Already we have started cross-sell. We will start giving numbers in a quarter or two. But on a steady-state basis, 1 year down the line, I think we'll be able to cross 30-40% of the existing database in terms of cross-sell. Now we are launching the EMI card, credit card, or the consumer loan. Because we keep getting inquiries and on the call center calls from the customer that they are looking for most of the services from the Poonawalla, reason being the existing customer. So I think whatever early signals we have, you can expect, I think we'll focus on loyal customer base. And the reason I told you just now to Kunal also about the trust and first choice of rejection we are getting because of the no hidden charges and product proposition what we have.
Okay. Could you also mention about right now? I understand when everyone is very improved asset quality coming from a high base of COVID, and even for us, we were also in a process of merger, and therefore we had done a lot of high provisions last year. Now, if you could talk about what is the likelihood of sustainable credit costs for our company? And when you build different products, what type of credit costs you build or estimate when you underwrite? So it means if you could talk more about underwriting skills and also what type of asset quality and credit costs would be sustainable.
So basically, the segment which we are targeting, whatever analytics we have done on the existing customer and the proposed customer base, next year you can consider the credit cost around 0.5, but on a steady state basis, the range I can give you anything between 0.5 to 0.8.
Okay. So
we are doing write-off at 90 plus. So we have to control the credit cost at the time of onboarding itself, because we have not changed policy. It is not only we are following only for the legacy unsecured book or legacy secured. This policy we have decided in March 21 at the time of acquisition for both secured and unsecured. So we do all the secured product write-off at 180 plus and unsecured at 90 plus. So to control the credit cost, I think whatever the first time collection and the one time match we collect, that is our main trigger. So we follow first time collection and 30 plus as our main trigger.
And your management overlay provisions, when does that get kicked in? Means when do you use them? Any policy around that? And how long do you continue creating? What type of proportion you want to create?
So basically, we have created this buffer only on the legacy book. We have not utilized any of the management overlay towards the new book. New book is performing quite well, better than our expectation. And this management overlay, I think now, as I told you, by end of March, will be less than 500 crore. We have started either selling the legacy book or writing off the legacy book. And still we are carrying 1,000 crore because of the early write-off, the total write-off book. And out of that, we will recover 450 to 500 crore. So you can expect there will not be any additional management overlay we will create going further for the legacy book, because we can expect write back, but not losses out of the legacy book.
And basically the entire management overlay would be used for the legacy book?
Yeah, that's created only for that purpose. We have not utilized any of the management overlay for the new book. It is only for the legacy book.
And when does, according to you, our legacy book becomes basically runs down to zero?
June 2023.
Okay, so then by then, if whatever is not required to provide, you would write back in the ensuing quarter, or you will choose to keep the buffer as it is?
Yeah, so I think we cannot use that buffer. We'll have to write back whatever is the balance provision as per the law and as per the rule as well. And whatever the write-off book is there, that 1,000 crore, that of course we can utilize towards the legacy book, and as and when required, like for example, we have recovered 75 crore last quarter. So you can expect that write back over a period of maybe 18 months. You can expect the quarterly write back from that book.
Okay, thank you. Abhay, last question on the treasury side. If you could talk about our cost of funds, and also if you could talk about what is incremental cost of funds and what, according to you, would be basically the benefits because of upgrade in the rating profile and the name Poonawalla. What type of repricing is already done, and whether our cost of funds are now on a like-to-like basis to our rating, or there is room to improve more?
Yeah, so right now cost of fund is at around 7.12, and we can expect 20 bits or maybe 40 bits depend on the RBI quarter-on-quarter basis. You can expect that hike, but however, we just started capital market borrowing, and there is a scope to borrow more via CP route, as well as we are carrying 1,400 crore of legacy book at 9.5%, which will get closed over a period of next 11 to 12 months. So considering that, I think the effect will be very gradual, and we have started increasing the rates in the last 2-3 months. So I think we will not face any issue due to cost of. Already we are amongst the lowest in terms of cost of borrowing. And if you see recent all our PSU bank sanction, first time we have received almost 7-year money at around 7.25 rate, and now we'll have to see any further increase from these banks. But again, in all the AAA rated NBFC, around 5-6 AAA rated NBFC, we are amongst the lowest in terms of you talk about the bank borrowing. So now with the increase of CARE AAA rating, you can expect 20 to 25 bits additional benefit via capital market borrowing, as well as 10 to 15 bits more benefit in terms of bank borrowing.
Sure. Thank you, Abhay. Thanks a lot for patient answering.
Thank you. Thank you so much, Rahul.
Thank you. The next question is from the line of Sameer Bhise from JM Financial Institutional Securities. Please go ahead.
Yeah, thanks for the follow-up opportunity. Just wanted to understand the movement on the default.
Sameer, you are not loud enough.
Yeah, hi. Is this better?
Yeah, now this is better.
Yeah. So the discontinued book has reduced by 760 crores or 740 crores on a sequential basis. Can you just give a split between how much was sold down, how much has been a normal repayment?
So 227 crore of legacy, all the sector CV products we have sold out, and remaining we have collected, and remaining around 330 crore we have done a write-off of additional write-off as well as the policy write-off. So this is the breakup. 330 crore we have done a write-off, 226 crore we have sold to one of the private bank, and remaining was the policy write-off of only legacy book. This is the breakup, Sameer.
Okay. And what was the interest reversal for the quarter, if at all?
Can you please speak loudly?
What was the interest reversal for the quarter?
Interest reversal?
Yeah. Must have been a small number given.
Yeah, I guess it was around 5 crore.
Okay. Sure. And just coming back to the OPEX part, just wanted to get a sense on how the number of employees is shaping up, given the large collection team you had inherited at MACMA, and how things are moving there with respect to the number of employees.
Yeah. So I think we have around 3,200 on-roll people and around more than 2,000 people off-roll basis. So as you speak, we have 5,200 people. And out of that, Sameer, we have more than 50% on the collection side. And this is the best part we have. That was the main reason behind MACMA acquisition, because we wanted to start with our existing experience of Poonawalla Finance. Now in Poonawalla Fincorp, consumer loan and a lot of other products wherein you require some kind of collection. So now we have good enough strong collection infrastructure available, and on-roll as well as the off-roll. As we move forward, we have done a lot of reskilling and retraining. Out of that, a lot of people are willing to move to the sales also, and remaining we will continue in the collection side.
Okay. This is helpful.
On book of 1,300 crore and the write-off book of 1,000 crore. So almost still we are carrying 2,300 crore of legacy book including write-off. So for that we need a collection infrastructure, which we have, because in the existing MACMA legacy book, maximum 50-60% is the cash collection. And right now in the new book, there is no single cash collection, and 100% onboarding via digital route, and 100% NACH, 100% digital disbursement, and 100% digital collection. So here the 60 plus itself is less than 0.5, and we are not expecting more than 0.9 credit cost. So we will not require much of the field collection, but at the same time, now we are moving towards a high-yield product, small personal loan, consumer loan, EMI card, credit co-brand card. Over a period of next 3 to 4 quarters, we are going to launch few high-yield products. And again, till that time, next 12 months, when they will complete all the legacy book collection, they will be all useful, because we have done the fresh assessment, and this is all desired population. Already there was a much more attrition, and we have allowed them to go because they wanted to focus on CV, tractor there as per the interest area. So now already account got reduced by more than 1,500, 2,000, which you will see a good amount of OPEX reduction that as well in the coming quarters.
Thank you, sir. That's all from my side. All the best.
Thank you. Thank you so much, Samay.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity once again. So just on the DSA sourcing front, I wanted to understand what is the responsibility, as in, like, is it only with respect to lead generation, or they are also responsible for some other, say, documentation and verification aspect also? So that's the first question. And the second question is, if you could give us the pricing range for our non-digital products, that is pre-owned cars, machinery loans, auto lease loans, and what would we paying to these DSAs for these products?
Yeah. So if you see the IRR, I think on a business loan side, we are maintaining a IRR of around 18.5%, pre-owned car around 15.7%. Loan to professional and personal loan, we are able to match average rate of 13.5%, the segment which we are targeting. And so coming back to your DSA question, I think their responsibility is to just log in the file as per the requirement. Since our entire process is digital, we have given them all the apps and whatever required login process, we have given them enough training. And now they are only logging the file wherever required. Our field sales people and wherever we have the branches, they help them with training as well as in terms of login. So, and going further, our focus is more and more on the digital. If you see, we just started pilot in Q4 of last financial year, and in the last quarter itself of the last financial year, we did almost 17.5% of a direct digital ecosystem, which almost increased double to 34% in quarter one, and now in Q2 it is almost at 47%. So going further, you will see more and more focus on the direct and the digital rather than the DSA.
Got it. So, but currently, like, what would be...
If you see loan against property, pre-owned car or business loan, this is the industry practice. I think this is largely driven by the DSA, but yes, our focus will be more and more on the digital.
Got it. And so currently, as you, like, in my earlier question, you had said that you pay 2 to 2.5% as a payouts to these DSAs, right?
Yeah, in case of business loan.
Right. Got it, sir.
Yeah,
Thank you so much, sir.
Thank you so much.
Yeah.
Thank you. The next question is from the line of Sagar Jetwani from Phillip Capital. Please go ahead.
Yeah, my voice is audible.
Yes.
Thank you. Sir, I missed it, sorry. You mentioned that, you will see a lower OPEX next year. What is the reason for that? I missed it completely.
Yeah. So very good question. See, basically, one, we are investing largely on the technology side in the current year. We are investing largely on the team as well, strengthening the leadership team. And most important, we wanted to retain the people. We wanted to focus more on the ESOP till the lower level management. So out of my 3,200 on-roll employees, we have covered almost 450 people via terms of ESOP. And we have 1,000 people manager and above, wherein this count comes to 45%, which is the highest in India. So from that perspective, I think the current year, the ESOP charge itself is 40 crore per quarter. It's almost 160 crore in the current year, which will get reduced to 50-60 crore in the next year, and again it will get reduced further. And this is again a notional charge on the P&L. But despite of that, if you see, there is a year-on-year and a quarter-on-quarter increase in the pre-operating profit. There is an increase in the revenue, and this one-time cost of technology, team, and ESOP will get reduced drastically from the next year. So you can expect a 1 to 1.5% reduction in terms of OPEX to AUM from next year onwards. But on a steady-state basis, 2 years down the line, I think we will be able to maintain level of, I can give you the range 3 to 3.5%, 2 years down the line.
Okay. And what is the mix between secured, unsecured, and also between, urban, semi-urban, and rural loan book?
I think we are focusing on urban and semi-urban. I think more than 60-70% is urban and remaining is semi-urban. In terms of secured and unsecured, as on September, 72% of AUM mix is secured and 28% is unsecured.
Yeah. And also, we are on track to achieve 21,000 crores of AUM by date. And by FY25, the plan is to get there to 40 to 45,000 crores of AUM. How can we see, FY24? I know it's a little bit early to ask, but still, if you have any target in mind, maybe.
So you can assume from here on the quarter-on-quarter growth anything between 6 to 8%. On a year-on-year basis, next 3 years you will see growth in the range of 30 to 35%.
That's helpful. Thank you so much.
Yeah, basically, I just want to add here, we have a capacity to disburse 3,000 crore per month. We are far right now not utilize our capacity. We have just crossed a monthly run rate of almost 1,300 crore from September. On the basis of the last 6 months and the basis of last 6 to 9 month consistency in terms of organic number, we are pretty confident of H2 and beyond as well.
That's very helpful. Thank you, sir.
Thank you, sir.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Hiren Shah for closing comments.
Thank you everyone for joining this earnings call with us. For any further queries or communication, please write to us at investor.relations@poonawallafintech.com. Thank you.
Thank you. On behalf of Poonawalla Fincorp Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.